Welcome to Growth Investing Mastery. This video will look at our April 2026 growth stock portfolio review. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to examine our growth stock portfolio as we head into May 2026. One thing we want to keep in mind is that we're playing a positive sum game where the audience can benefit here. And getting feedback on new stock names is really valuable for myself. We'll examine the AI growth stocks that propelled my portfolio higher this month. And we'll also give details on non-AI stocks that overperformed in the month. Let's jump into my current allocations. I have 4 high confidence or high allocation positions. These include Astera Labs at 14.9%, Credo at 14.4%, AppLovin at 13.1%, and Iren at 11.4%. We then have 8 medium-sized positions. These include Silicon Motion at 7%, Reddit at 6.9%, Ethos Technologies at 6.3%. That's followed by Pattern Group at 4.9%, Micron with 4.3%, FIGR Technology with 3.9%, and then XTI Aerospace at 3.5%, followed by Electrovaya at 3.3%. To round out the portfolio, we have 6 low confidence positions. These include Allegro MicroSystems at 1.5%, Sandisk at 1.5%, Dave Inc. at 1.3%, and then we have Viant Technology at 1%, Lumentum at 0.5%, and TOYO at 0.4%. And I have the stock symbols bolded here if you want to look up any of these stocks on your own. This is the most stocks we've had in our portfolio since the start of the channel. And it may lead to the question, is this still a concentrated portfolio? One thing to keep in mind is our top 4 stocks make up 54%, the top 7 stocks are 74%, and our top 12 stocks make up 94% of the portfolio. I've been finding a ton of new promising opportunities recently, and for a lot of those names, I'd rather have a starter position than see them keep going up on my watch list. And we'll also get into a little bit of strategy later, why the number of holdings in my portfolio is going up as the market is rising. Let's take a look at our portfolio changes on the month. During the month, we added to Ethos Technology, Pattern Group, and Reddit. I trimmed Astera Labs a little bit when the stock had a good run, and my allocation got to nearly 20%. And then I also trimmed significantly in FIGR Technology, XTI Aerospace, and Micron. And most of the money from the trims went to starting new positions in Silicon Motion, Allegro MicroSystems, Viant Technology, Sandisk, Dave Inc., Lumentum, and TOYO. And then lastly, I ended up selling Nebius on the month. Let's now take a look at my results. The cumulative return for my portfolio since the start of 2024 is plus 479%. But my portfolio has not gone in a straight line up. There have been a lot of ups and downs in between. In 2024, my portfolio was up 146%. That's followed by 2025, where my portfolio was up 112%. And then finally, we got back in the positive this year, which was encouraging at plus 11% year to date currently in 2026. Let's take a look at my progress throughout the year on results with the year to date point in time numbers. We started off January being up 4% year to date, but that was followed by a really tough February and March. We ended February down 16% year to date and ended March down 20% year to date. We know from our past results, some of these swings back can happen pretty suddenly in a month. And that's what happened here in April, where we're up 11% year to date now. I did get curious where the NASDAQ was year to date, and it looks like it's up 7% year to date. Normally, I don't focus too much on what the indices are doing. And this is partly because just setting a goal of beating the index is a low bar to set for a growth investor. One thing to note is we're actually still below our all-time portfolio highs in October of 2025. And that's what I mean by there being a lot of ups and downs in my portfolio results. But you can see how when the market gets interested in buying growth names again, how my portfolio rebounds strongly. Let's take a look at my market and portfolio commentary for the month. And you might be wondering, why did I go from 12 stocks on the last monthly summary to 18 stocks now? Part of my strategy is to expand the portfolio in bullish runs and contract in bear markets. I realized I had not detailed this in a strategy video before, but the sudden bear to bull market for growth stocks happened quickly, and this created the contrast in the number of holdings going month to month. I started thinking more about why I'm adding more stocks as the market starts rising, and also why I'm concentrating in fewer stocks when the market is going down. When the market was going down in February and March, the opportunities in my best stocks quickly become very appealing. For example, Ethos Technologies at $10 a share or Credo at $100 a share seem like incredible opportunities. And I'm willing to cut my 13th and my 14th best stocks to take advantage of the situation. I was fortunate those moves to concentrate turned out to be good calls. Ethos Technologies is now at $18 a share, and Credo is at $170 a share. However, the opportunity in these stocks doesn't seem as glaringly obvious now as the price had such a big run-up. Also, we recently had stocks like Astera Labs go on a big run, and they ended up becoming an over-allocation versus my confidence. As Astera Labs got close to 20% of my portfolio, I began trimming Astera Labs some. And this naturally frees up cash for watchlist companies and completely new companies that I researched on the month. I'm expecting this earnings season will provide another boost to my portfolio returns. But I wrote here, I always think this. And I always seem to go into earnings season quite optimistically that most of my companies will do well. It works out that way maybe 2/3 of the time where it goes pretty well during the earnings season. But sometimes we do have tough earnings seasons, like the one back in February. And months like March, which are really tough for growth investors, can make a growth investor question their sanity. And I kept thinking, why does the market no longer respect fundamentals and is just pumping these narrative-only stocks now? It can impact a growth investor's confidence when an individual stock portfolio is underperforming the market. And that's what was happening to me, where my confidence was low as I was underperforming the market, and I was wondering what's going on and why my approach isn't working like normal. One key takeaway here is that strong fundamentals become undeniable to the market. This is what happened with the company Silicon Motion, which I recently added to my portfolio. The company posted incredible financials and gave really strong guidance. And even though it's not a well-known or popular name, the stock still went up about 50% after that. And one more key takeaway is that stocks getting dramatically undervalued can suddenly wake up. That's what happened with Ethos Technologies this month. The company had a trailing PE of 8 and a revenue growth rate above 50%. And it started going up every day this month to catch up with its valuation. Now let's jump into the individual growth names in my portfolio. My highest allocation position is Astera Labs with symbol ALAB. The product is AI Networking Infrastructure 2.0. There's not been much news prior to this upcoming earnings report next week. However, Astera Labs is a company which typically doesn't do press releases for individual deals. What seemed to kick off the price rise in Astera Labs on the month was that Anthropic and Amazon made a partnership, and this propelled the stock of Astera Labs higher. Astera is at the center of Amazon's Trainium chip with the Scorpio switch, as it's called, from Astera Labs. The switch is being enabled for both copper and optical connectivity, and the company has described this switch, along with their software platform, as the digital nervous system for the systems they're building. It's good to know that earlier this year, Amazon made an investment in Astera Labs tied to sales in its Scorpio switch. And this is likely where Astera got confidence to hint at a strong ramp for Scorpio in 2026. I was surprised earlier this year to see Astera Labs lag the other AI stocks significantly. This is because usually the market places innovators as leading the pack for a bullish rally. And the over 75% gross margins that Astera Labs has indicates this is not a commodity product. Custom silicon-based designs get a premium on pricing and margins. It's also worth noting this stock has never been cheap since its IPO. However, other semiconductors in the space with worse profitability and margins are now seeing higher price to sales ratios than Astera Labs. As I mentioned earlier, I ended up trimming Astera Labs a little bit. The main reason being it was getting close to being 20% of my portfolio. My next highest allocation stock is Credo with symbol CRDO. They make AI networking products with both optical and copper. I learned recently that some of Credo's products go into other companies' transceivers, but then for certain products like zero flap optics, Credo sells the whole component. They say that's one of their competitive advantages to be vertically integrated and control more of the production. Credo recently acquired the company Dust Photonics for slightly over $850 million. And the deal came with significant performance bonuses for the management at Dust Photonics if they do well. The acquisition brought some attention Credo's way for their optical products. And still I'm kind of surprised that the market seems unaware that Credo has these optical products. In fiscal year of 2025, which is over a year and a half ago now, Credo already had over greater than 10% of its revenue coming from photonics. But the company doesn't seem to rally with the other photonics stocks, possibly because it's not a pure play optics manufacturer. I see Credo having significant innovation over other commoditized optics makers. Credo's management has done a good job detailing that aspect as well. The company's zero flap optics addresses one of the key reliability issues that plague optics right now. Because Credo has this added innovation, they get better profitability and margins than most other optics makers. Credo was similar to Astera Labs this month, where the stock rallied on the Amazon and Anthropic deal. And it's worth keeping in mind that Amazon was Credo's oversized customer 1 year ago. So it's definitely good news for Anthropic and Amazon to be making a deal with the Trainium chip. That should play in Credo's favor. Amazon is still a big customer for Credo, but Credo's revenue has diversified significantly amongst its top customers. And we also know that Oracle is a big customer of Credo, buying both optical and copper products, depending on the scenario. I'm expecting a really strong earnings report for Credo at the beginning of June. It's worth noting with Credo's management, they're unlikely to brag or start pre-announcing customer deals. We've seen that from other stocks in the space, where every time they get a deal, they do a press release. However, we are expecting Credo to deliver huge results and shock the market. The next company I own is AppLovin with symbol App. They are a gaming ad tech platform with an expansion into e-commerce. And the stock seems to have gotten caught up in the enterprise SaaS downturn. But AppLovin does not have traditional B2B sales like a SaaS company does. And the company is in a category of their own on growth and profitability. For this upcoming report, revenue is projected to grow 53% year over year, with $1.78 billion of revenue. On the previous quarter, the company had a GAAP net income margin of 66%. And this is keeping in mind many SaaS names are unprofitable with a negative net income margin. Some of my takeaways on this stock are that much of the upside depends on the expansion to e-commerce. It seems like the general availability launch for e-commerce may be about 1 to 2 quarters behind their original schedule. But the explanation of onboarding improvements and product enhancements makes sense to me. I've seen some mixed reports about the return on ad spend metrics for AppLovin. However, it seems like the majority of the reports say the platform is performing well. But there are a few short theses floating around out there that I've read about as well. The question mark now is if the next quarter will already guide based off the higher e-commerce revenue, or will management play it safe and not look to factor in too much upside on e-commerce? My next highest allocation stock is Iren with symbol IREN. They are a neo cloud with an expertise in power management. This past quarter, management has been unusually quiet on press releases and potential deals. And there's even a meme about when deal where when is spelled WEN. The company announced on May 1st they had a successful energization of their Sweetwater 1 facility. This is in line with the original company timelines, and the company is one who prides themselves on never missing a deadline. There's been some rumors that Iren may have an Australia deal in the works, and I've seen people on Twitter tracking down a bunch of clues in regards to this. There's open engineering roles posted on their website for their Australia location. And both Microsoft and Anthropic were said to be eyeing Australia as a potential place for expansion. Also, there's been a marketing ramp for Iren in Australia. I've seen some pictures where the tram car has the brand Iren in Sydney, Australia. One thing to keep in mind is that this upcoming earnings report is likely to be narrative driven for how the stock price performs. That does make me nervous. I cannot rely on accelerating financials to carry the day for the stock price. And the company's mining operations for Bitcoin saw decreased Bitcoin prices the entire quarter. So the headline financial numbers are unlikely to impress. And I probably would have trimmed more shares here for Iren, but all my Iren shares are in a taxable account and they've yet to lap the long-term capital gains that will happen in August for my shares. So I'm just going to see how this earnings report goes and then reevaluate from there. But lately I'm preferring stocks with more proven business models lately. And while capital is widely available for these neoclouds right now, if there's an economic downturn, those funding sources could dry up. The next company in my portfolio is Silicon Motion with symbol SIMO. They are a fabless semiconductor for memory controllers. And our last video on the channel was about this company. They posted an absolutely stunning earnings report which surpassed my expectations. After the report, I noticed that analysts' revenue models have yet to catch up. I put a screenshot over on the top right side of what analysts expect for the remainder of 2026 and into 2027. Silicon Motion guided for $411 million of revenue at the top end next quarter. When we look at what analysts are projecting for 2026, in Q4, there's $446 million of revenue projected. And Q4 is Silicon Motion's strongest quarter. And the management team said they'll grow sequentially throughout 2026, so that estimate seems low. And then in 2027, when Silicon Motion says they'll see a big ramp, the analysts are projecting only 2% growth for full year 2027. On the latest earnings call, management says they see even bigger volume ramps at Tier 1 customers in 2027. Silicon Motion does not refer to any of its customers by name for confidentiality reasons. So they end up calling customers like NVIDIA and Google Tier 1s. Another detail from this latest earnings is that Silicon Motion is gaining share as NAND flash makers outsource more. Competition is decreasing, they said, for their eMMC product line. And just stepping back for a second, I don't recall the last time I've seen a company in a growing industry where they say competition is decreasing. Later, the management team added that 2026 will be a defining year for our client SSD business. And their MonTitan product line is squarely in the middle of the data center transformation. Volume production ramps for MonTitan have been happening 1 quarter ahead of schedule due to their fast qualification process. And the team detailed how there are 5 major additional customers later this year for the MonTitan product line. They said MonTitan has a unique technology. It's called performance shaping. They described it as being very, very good for AI inference. Our big takeaway here is the business is gaining market share across different product lines as the competition collapses. The valuation for Silicon Motion still seems reasonable even after this big run-up in share price. I believe it's undervalued versus other semiconductors. For example, the run rate price to sales for Silicon Motion is 5.8, and most other growing semiconductors have a much higher price to sales ratio. My next portfolio company is Reddit with symbol RDDT. Their product is community-based social media, and the company just reported earnings early in the season. They had guided revenue from 595 to 605 million in Q1. That number came in at 663 million for the top line. It's a pretty sizable beat, but it's in line with what Reddit usually beats by. On adjusted EBITDA, management had guided from 210 to 220 million, and this came in at 266 million. For the next quarter, Q2 revenue was guided from 715 to 725 million. I was looking for a bit more on this guidance, and I saw some other investors say the same thing. Analysts had modeled for 715 million in the next quarter, so Reddit is guiding for only slightly higher than the analyst estimates. But it's worth keeping in mind that the company usually is beating the revenue guidance by over $50 million like they did in this current quarter. The profitability numbers made up for the weaker guidance in my mind, though. Reddit had record cash flow in Q1 of 300 million, and this is versus Q4's 265 million of cash flow with a higher revenue number in Q4. So it's really interesting how they got this higher cash flow in Q1. For next quarter, adjusted EBITDA is guided for 295 million at the top end, and that would be up 77% year over year. It's really encouraging to see that profitability is growing this much faster than revenue. In the current quarter, the company got GAAP net income of 204 million, and this is up 7x from a small base previously in the last year. The team also detailed how active advertisers grew by over 75% year over year. Overall, I thought this was a decent report, but I'm planning to trim slightly. I would have liked to see more clarity on their data licensing business. This data licensing only grew 15% year over year. I had heard some rumors they might be rebuilding this part of the business, but it doesn't seem to be playing out yet. I'd be hard-pressed to sell the stock here, though, given the increasing profitability metrics. Lastly, management talked about how they're not looking to load up on the ad slots. They want to grow users and make impressions more valuable. My next highest allocation position is Ethos Technologies with symbol LIFE. They are a life insurance platform for consumers, carriers, and agents. The stock had gotten incredibly cheap earlier in the month with a trailing PE of less than 10. And fortunately, the stock has gone up nearly every day in the month, being up close to 70% for the month. On April 23rd, the company announced they have a new partnership with Liberty Mutual to expand their direct-to-consumer offering. Liberty Mutual is a large non-public insurance company with over $50 billion in annual revenue. I confirm this partnership appears to be brand new. It's not an expansion deal. On their business more generally, Ethos said, "For many of our carriers, Ethos is their single largest source of new life premiums." The company activated over 54,000 policies in Q4, which was up 42% year over year. And they mentioned on their latest earnings the average revenue per policy was $2,012. I did learn recently this revenue per policy can vary dramatically. It depends what type of life insurance the customer is getting and for how much. On the company's new cancer insurance product, they said it's really early innings. Management detailed in the latest earnings call how they consistently improve our unit economics. One big takeaway from the previous earnings call was they said new policy activations were strong in January, and February was ahead of targets. I like that they're hinting at a strong Q1 already. And this Q1 coming up is their seasonally strongest quarter. I'm expecting strong headline numbers for the company's earnings press release later this week. One thing I'm looking out for is the sales and marketing spend on this upcoming quarter. Previously, it was growing about the same rate as revenue. And I would like to see a quarter where sales and marketing is growing slower than revenue. My next medium allocation position is Pattern Group with symbol PTRN. They are an accelerator for e-commerce brands. Recently, Pattern Group got named TikTok Shop's 2025 Strategic Partner of the Year. The company is reporting earnings soon on May 6th. We'll be keeping an eye on the SaaS services and logistics side of the business. Management detailed how this part of the business grew 58% for the full year and an impressive 168% in Q4. My takeaway is that adding more SaaS services could really improve this company's margins and profitability. The team mentioned how there's a data moat and a logistics moat. They're executing quickly from machine learning. On this next earnings report, I'm looking to see non-Amazon revenue get to a higher percentage. In Q4, the company saw triple-digit growth year over year in Coupang, TikTok Shop, and Walmart marketplaces. They also detailed how they added a total of 12 marketplaces over the course of 2025. Management also talked about operational efficiencies. These efficiencies were resulting in improving days inventory outstanding or having less inventory on hand. Last year, Pattern launched their Las Vegas facility, and this year they're launching an East Coast facility. The company recently had two small acquisitions. The first was called ROI Hunter, which is a data platform from the Czech Republic. They also acquired Next Wave, which is a TikTok Shop operator. My takeaways from reviewing their last earnings was that the commentary from the last earnings was really optimistic. Because of that optimism, I'll be looking for the company to overperform on financials and raise guidance for the full year. The next company I own is Micron, with symbol MU. They're a US-based memory maker. Rising memory prices have greatly benefited this business on growth, profitability, and margins. On the NAND side of the business, one analyst noted that Micron is one of the only players to talk about greenfield capacity adds. In the company's prior earnings report in March, they said both NAND and DRAM prices were up strongly. They saw NAND rising more than DRAM. And that was actually one of the factors for why I started a position in Sandisk again after reading that. Vector databases and key value cache offload are two of the main use cases for NAND. On high bandwidth memory, one analyst noted that Korean peers have raised pricing by 100%. One direct quote from the last earnings call was discussing the insatiable appetite that these AI servers have to have fast storage capability available. The team detailed how they expect compute architectures to become more memory intensive over time. There's continuous high bandwidth memory content uplifts, they call it, with each new generation of XPUs. And XPU is just a catch-all term for any chip that's a CPU, GPU, or ASIC. Later on, the company expects new demand vectors such as robotics to play a larger role. When they were asked about the conflict in the Middle East, they said they don't see any supply risk. They added there's a very, very minimal impact to cost. The company is expanding its factory capacity in Idaho and Singapore, along with other sites. These new fabs will speed up time to market for leading-edge products. And in turn, the company's increased its fiscal 2026 CapEx projection to up to $25 billion now. Previously, they guided this number to $18 billion, and then they raised it to $20 before going up to $25 now. The management team detailed how they expect CapEx to be over $35 billion in 2027 as they build out global manufacturing sites. Lastly, the team added they're able to fulfill only 50% to two-thirds of their demand in the medium term. So it still seems like demand is way outstripping supply here. I had mentioned at the beginning that I trimmed Micron significantly, and this was really because I wanted to add to my Silicon Motion position, which was also in memory. It wasn't because I lost confidence in Micron. Also, Micron is reporting later in the season, and the stock is going on a really nice run prior to earnings. My next portfolio company is FIGR Technology, with symbol FIGR. They do blockchain-based tokenization for financial products. I began trimming back my position significantly in the month. This is because I thought the March operating data they reported was a mixed bag. The good news was the consumer loan marketplace volume was up 33% quarter over quarter and 102% year over year. However, March is a much stronger month than February for home equity lines of credit, so I'm not too sure how meaningful those quarter over quarter raises in numbers are. One of my areas of concern was with their yield stablecoin. Yields in circulation went from 588 million in February to 598 million at the end of March, and this was up 2% month over month. However, I've been tracking yields through a live tracker site throughout the month, and on May 3rd, the yields balance is down to 528 million. I did understand last month that the yields balance may fluctuate, and maybe users are not using it as a store of value. This is because loans get funded through their platform, and then participants cash out their yield stablecoins. That explanation makes sense, except management told us to expect an exponential curve for yields. Here's the quote from their last earnings call. We expect yields adoption to continue to accelerate on this exponential curve as more partners recognize the efficiency benefits of blockchain-based atomic settlement. Additionally, on the democratized prime numbers, they're also seeing single-digit growth month over month. I thought that marketplace would have been picking up a lot more as well. With regards to their blockchain stock market, it seems to have lost some momentum from my perspective. When we first got into this stock, it sounded like the SEC approval for the blockchain stock market was right around the corner, but we really haven't had any significant updates since then, although the company's alternative trading system did go live. So it sounds like they have the technology ready for the blockchain stock market, but I'm not sure they can get the approval. One thing I noticed is that consumer loan marketplace for the Q1 quarter can already be calculated since they gave us the monthly operating data. I'm expecting the growth of the consumer loan marketplace to be 113% year over year, based on the numbers they gave. So I'm going to stick it out for the next earnings and see how that goes, but my enthusiasm for this name has gone down. The next medium confidence position I have is XTI Aerospace with symbol XTIA. They are a distributor of off-the-shelf drones. I ended up reducing my position some heading into the earnings. And this was because I noticed the company delayed a filing at the start of April, but I only noticed on April 7th. The company made it just in time on April 15th along with their earnings, but it made investors like myself sweat towards the end there. The Q4 report sounded optimistic since taking over the Drone Nerds business. And Drone Nerds makes up practically the whole business now, as the legacy Trifan 600 aircraft was put on hold. Management reaffirmed the $160 million of revenue guidance for 2026, which I found encouraging. That would make the stock quite cheap if they're able to hit their revenue numbers. The financials in this report were a bit tricky to parse, as it included a half quarter of the acquisition and then costs related to the acquisition. But prior to the Drone Nerds acquisition, the Drone Nerds business was GAAP profitable. The entire organization is now being updated to go all in on this new Drone Nerds business model. Most sales currently are to commercial firms, and that leaves upside in government contracts. The US government's move to buying COTS or off-the-shelf drones is a benefit to XTI. Previously, the government was more in favor of advanced R&D projects. XTI does sell the DJI drone, which is the most well-known Chinese manufacturer of drones. They can sell these DJI drones to commercial businesses, but not to the government. That's for compliance reasons, and XTI also creates NDAA, or US-based compliant drones. The business had 14,526 unique customers in the quarter, but this only grew 2% year over year. This stat used to be a previous concern, but the company explained they moved more to enterprise sales. So some of these unique customers are more valuable than the previous small ones. And the company does have some surprising names as customers that you wouldn't probably expect. These include Sam's Club, John Deere, Royal Caribbean, and General Dynamics, to name a few. One thing that bothered me a bit in the latest earnings report was the CEO gave no prepared remarks, but he put the prepared statements in the 8K filing, which he mentioned a few times. The part that I didn't like is he said he didn't want to waste people's time. And the 8K filing of the prepared statements was a pretty good read, but this non-standard practice is not a good look for the management team. Additionally, the company said their press release for results would come out on April 14th after the market close. They followed that by saying that the conference call would be on April 15th in the morning. But the issue was they didn't do the press release for their earnings until the next morning. And that left me concerned that something had gone wrong with the filing. Fortunately, that wasn't the case though. Also, this company was just reporting Q4 of 2025, and they should be reporting Q1 of 2026 soon. I also thought it would have been good of them to give us a date for that. But I'm still sticking in this company to see how a full quarter looks coming up. Another portfolio company we have is Electrovaya with symbol ELVA. They produce next-gen lithium-ion batteries. The company is reporting earnings in May, and I'm looking to see a strong financial performance on this next quarter's earnings. There were 2 press releases in the month which sound promising. The first is they're working with the Department of Energy on a battery project for backup power. And the company also announced they launched their Infinity lithium-ion battery systems for walkie pallet jacks, they're called. And apparently walkie pallet jacks are common in distribution centers, warehouses, manufacturing plants, and retail stores. So even though I'm not familiar with the technical aspects of what that is, it sounds like there's a wide use case for them. On this next earnings, I will want to see progress on the US-based Jamestown plant and what timeline updates they have there. The Jamestown unlock will gain further efficiency and profitability by unlocking the 45X tax credits as well. I'll also be looking for continued narrative updates on robotics and airline ground transport. I still see the stock as well underpriced versus US competitors, but I think this stock will need a strong financial performance to gain a lot of interest from the market. The next company I own is called Allegro MicroSystems with symbol ALGM. They are a new position, and it's one I'm pretty excited about heading into this earnings season. They make sensors for motion control, and they're expanding with data center products as well. I view this company as having the potential to be re-rated by the market as an AI stock. Currently, the company's sensors are embedded in power steering, EV motors, and transmissions. The expansion to the data center comes through high voltage gate drivers and fan drivers. Revenue in the latest quarter was $229 million, which was up 29% year over year. They guided Q1 2026 to 22% revenue growth at the midpoint of their guidance. But I'm expecting them to beat their guidance and then be able to guide strongly higher. This latest quarter saw profitability as well, with GAAP EBITDA of $27 million, net income of $8 million, and gross margins landed at 47%. My expectation of the strong guidance going forward is based on the narrative the company is telling. They mentioned that dollar content per rack in the data center is going from $150 to $425 in the future. I like that they were able to give a specific dollar number per rack. It likely means they have some design wins already lined up. More fans are going into each rack, and that's how they're expecting this higher dollar content per rack. On the topic of cars, they said content per car is increasing our dollar content by upwards of 2 to 3x. That sounds really promising that their main market may 2 to 3x per vehicle. Another area that Allegro is expanding is in advanced humanoid robots. Robots that are currently being built include 150 Allegro sensing integrated circuits and 50 power integrated circuits. One direct quote was, "Humanoids are where the real dollar content is." They later added on humanoids, "The dollar content is high." The management team detailed how they're getting cost reduction from vendors and seeing factory efficiencies. One small drawback to the company is they're paying down a term loan of $285 million, and their cash balance is a bit smaller than that at $163 million. But it's not a very big concern because of the GAAP profitability, and the company is already paying down this debt sum. I will be reevaluating Allegro MicroSystems after the next earnings to see if they can really step the guidance up. The next company I have is Sandisk with symbol SNDK. I added Sandisk back to my portfolio around the middle of the month. They are a NAND memory maker. This past quarter that the company just reported, they were guiding revenue from 4.4 to 4.8 billion. This landed at 5.95 billion, which was up 97% quarter over quarter and 251% year over year. Normally, headline numbers like that would produce an enormous rally in a stock. But Sandisk had high expectations and a lot priced in going into this earnings. On revenue for the next quarter, the company guided from 7.75 to 8.25 billion. Additionally, this current quarter had really strong profitability metrics. Adjusted EPS was guided for just $12 to $14, and this came in at $23.41. The company is seeing tremendous pricing power currently, but they did detail on the call how they're moving to more multi-year agreements with customers. I was wondering if that may reduce their pricing power over time. Some analysts mentioned that the EPS guidance implies a slowdown in price raises. But notice they didn't say a slowdown in prices, they said a slowdown in raising the price. I expect management is likely to be conservative on expectant price rises. And this current quarter was a massive beat, so I'm not too concerned about things slowing down just yet. But I am wondering what Sandisk's factory capacity expansion is. They said on the call they rely on the much smaller Nanya to produce DRAM. As I was tracking this down, I learned that a little bit of DRAM is necessary to create most NAND products. And Sandisk does not produce DRAM, so they have to procure it from someone else. It does seem a bit strange to me that Sandisk would not try and expand into the DRAM market a bit. But I'm guessing this is because NAND is seeing further price rises over DRAM. The other memory maker we own, Micron, is talking about producing new fabs a lot. And I don't think Sandisk is expanding their factory capacity as fast as Micron. I'm still wondering why that is. My overall takeaway is the numbers are incredibly good for this current quarter, along with strong guidance. The company reduced debt completely and is now producing a lot of cash. But one thing I'm thinking about is the stock may have priced in a good amount of upside, as the name is well known by the market now. My next portfolio company is Dave Inc. with symbol Dave. The company produces a membership-based bank. I decided to add Dave back to my portfolio again after I sold them last month. What happened is I started rethinking my sell decision after I had already sold. I did get a few questions from the audience of why did I sell if the financials did not deteriorate? And I think that's a good question, and it's not my typical style to sell out of a company on competition fears alone. Dave has found a way to overperform peers in a tough space. There's a lot of well-funded neobanks and buy now, pay later players. But it was really looking at the financials again for Dave, which convinced me to start a position. The gross margin trend over the last year and a half is really impressive. It goes from 51% to 62 to 68, 69, 72, and then to 75% gross margin in the latest quarter. Additionally, Dave's GAAP net income margin of 40% is incredible for this type of business. For example, a larger peer Chime with symbol CHYM has triple the revenue, but Chime has a negative 8% net income margin. So while Chime is unprofitable, Dave is profiting massively. One overall takeaway I have for Dave is the stock seems reasonably cheap still. The run rate price to sales is 5.3, and the run rate price to earnings is 13.2. So the market seems fairly pessimistic for a stock that's growing revenue over 60% year over year. But I will be looking for Dave to land strong with guidance raises and profitability numbers that look good. Another new company that I added to my portfolio in the month is Viant Technology with symbol DSP. They are an ad tech platform in the CTV space, and they compete with The Trade Desk where they're taking market share. The headline numbers for this company do not tell the full story because Q4 was going against political spend last year. The management team stated this explicitly where they said, "Our underlying business is performing stronger than our results." And the top line 22% revenue growth would have been 28% on an even comp. Viant has a market cap of just 700 million, and that's against 110 million of quarterly revenue in Q4. But keeping in mind Q4 is their seasonally strongest quarter. The company's balance sheet has 191 million of cash and just 22 million of debt. Adjusted EBITDA in the latest quarter was 24.7 million, which is up 45% year over year, showing the impressive profitability of this business. Even more impressive, cash flow from operations was 33.1 million, and this was up 101% year over year, while free cash flow was 28.2 million, showing growth of 132% year over year. The company said they saw broad-based growth across different verticals, driven by accelerating CTV demand. And they mentioned how 50% of the CTV ad spend on their platform goes through their own direct access premium, it's called. They talked about the Viant Household ID is becoming a standard. One direct quote was, "Our household ID is truly ubiquitous." The management team was recently at the Morgan Stanley conference. They were discussing their household ID versus a solution that the trade desk has. And they said, "We absolutely crushed the trade desk. We crushed their incumbent platform." On Viant's latest earnings call, they talked about beating the competition as well. They said they're beating much larger competitors at a late stage in the game. The company has a fully autonomous solution called Outcomes, and it outperforms human experts. The stats they gave were that a human expert got $135 of sales for every $33 spent on advertising. Yet the autonomous Outcomes got $160 in sales for that same $33 ad spend. One big takeaway is the top line numbers are not super impressive yet, but this business sounds like it's massively overperforming. And I will want to see really strong financials to go along with the big game they're talking about beating the competition so badly. My next portfolio company is Lumentum with symbol LITE. The company makes optical components for high-speed data transmission. I'd mentioned Lumentum before under the promising new ideas section, but I did not end up investing while the stock went on a big run. What changed my mind is I began to view the company as an innovation engine after listening to the special call they had on March 17th. They talked about their optical circuit switch called OCS that connects data center servers, and it seems like a one-of-a-kind or a unique solution in the market. The term switch may sound familiar if you also follow Astera Labs, but the type of switch that Astera has is more internal to the chip. This means that Lumentum and Astera are not really competing against each other here, as their switches serve different parts of the hardware stack. I found an interesting product description for how Lumentum's OCS system works. And it said, when you connect GPU 1 to GPU 150, the mirrors tilt to create a direct optical path between them, and the light signal passes through without being converted to electrical packets and back. When discussing competition, management said they have a really big lead, and they've spent years and years perfecting these technologies, they said. On indium phosphide capacity, which is a key component in their supply chain, they said we have more capacity than any company in the world. And Lumentum is building a new indium phosphide fab in North Carolina. Detailing more about Lumentum's OCS solution, they recently closed a large multi-billion-dollar deal, and they said OCS is performing remarkably well. We're well ahead of competition, they said. From what I was able to gather, Lumentum's products are part of the optical scale-out with NVIDIA. And even knowing they had NVIDIA as a customer, the management said they're surprised at the additional backlog that's coming in. They said the company is vastly under shipping versus the market demand. And they said the demand we see is so very, very high. They talked about in recent conferences how they're sold out through calendar 2027, even as they're bringing on additional capacity. But I wasn't actually sure if they're sold out for all product lines or just specific ones when they made that statement. Either way, this business sounds like it's performing incredibly well. but the stock price has had a huge run up, and that's why I'm being a little bit cautious about my allocation percentage right now. The last low confidence position I have is TOYO Co with symbol TOYO. They're a solar cell manufacturer that is ramping up fast. And just so you know, there's a bunch of companies named TOYO, but if you want to find this specific one, you can add the word solar, which sometimes helps narrow it down. TOYO is a Japanese US listed company, and they report in halves. But they announced on their recent second half report that they're switching to quarterly reporting, and they'll have another quarterly report in May. When they reported the second half of 2025, they had $288 million of revenue, which was up a stunning 641% year over year. The company is already profitable with GAAP EBITDA of $74 million and net income of $36 million. Gross margins in the latest half were 26%. The company has $59 million of cash, but they do have $133 million of debt, which is quite big in relation to their market cap of $470 million. In Q1 of 2026, or just a single quarter, analysts are expecting $203 million of revenue, with $46 million EBITDA and $25 million net income. The company is quite cheap with a trailing PE of 11 and a forward PE of 5.4x. TOYO started their operations in Vietnam originally, and they were a spin-off from another Japanese company. When the US tariffs hit, the company scaled up insanely fast in Ethiopia. TOYO was selling into the US a lot, and Vietnam got a high tariff while Ethiopia had a low tariff. Additionally, the company has been scaling up in Houston, Texas as well. Part of the reason the company can scale up so fast is they're using robotics in factories. When I looked at this company's regulatory filings, they say they value Japanese efficiency and culture. The Ethiopia facility is already confirmed to be sold out through 2026. The company did 4.5 gigawatts of solar cell shipments in 2025. This was ahead of earlier projections of how much capacity the Ethiopia facility would have in the year. And I believe when they talk about gigawatts in terms of production building like this, it means gigawatt hours. And some of these technicalities around electricity are a bit hard to understand. But from the investor perspective, this company was ahead of targets on how much they were going to produce. The Ethiopia facility only got fully operational in October 2025. So there's going to be a big boost to revenue coming in 2026 as that's fully online now. Additionally, the Houston facility will qualify for 45X tax credits. I do have some concerns or bear cases for this company, which is why I'm keeping it at a pretty small percentage right now. There was a short report a few years back that alleged the Vietnam facility was actually sourcing materials from Chinese forced labor. And it was hard for myself to determine how much of that information might be real or not. Additionally, the founding of this company is a bit strange, with a spin-off. The parent company is a majority shareholder, but the parent company has a smaller market cap than TOYO, as it seems like the parent company hasn't done as well, and TOYO has outperformed. Since the company said they'll report quarterly sometime in May, I'm planning to keep a small position and reevaluate from there on the next report. One company I sold this month was Nebius with symbol NBIS. Alright, Nebius bulls, don't get too mad at me here. Nebius is a neo cloud with a growing software platform. The stock had a big run up in the month, getting nearly 60% gains since when I bought it. That played a big factor in my selling decision, but I also had growing concerns over the company's other businesses. I'd heard a lot that some of these businesses that Nebius invests in are some of its greatest assets. But when I started digging into the financials behind these other businesses, it seems like profitability is an afterthought. The latest filing from about a week ago shows how deeply unprofitable these businesses are. For example, with AV Ride, in 2025, the company had just $1.3 million of revenue, but they had adjusted EBITDA of negative $82.7 million. So AV Ride is practically pre-revenue and burning through cash. Triple Ten is another business where Nebius is the majority shareholder. In 2025, Triple Ten had 54.1 million of revenue and adjusted EBITDA of negative 41.2 million. The company Tolaka is no longer included in their latest filings, and this is likely because they're no longer a majority owner and not required to declare this one individually. But the filing from last year showed that Tolaka had 26.4 million of revenue in 2024 and adjusted EBITDA of negative 40.1 million. So it's another business where the adjusted EBITDA losses are even greater than revenue. With the company ClickHouse, which is their most valuable equity stake, ClickHouse has done multiple capital raises over the last year and is also unprofitable. The problem from my perspective is that all four of these businesses are not making money. This means they're capital intensive or capital hungry, and Nebius will need to raise more money to keep these businesses funded. That's in addition to capital raises for their data center business as well. And these four businesses where they have big investment stakes span four different segments or niches. The businesses are in ride sharing, education, a data labeling platform, and an analytics database. Additionally, when I was researching the progress on Nebius's New Jersey facility, I went down a bit of a rabbit hole on some potential problems here. The builder in Vineland, New Jersey, Data One, is missing the air quality permit, but they started building ahead anyways, and now it seems like it's not a rubber stamp issue and they actually need this air quality permit. I did see one thread that Nebius may have fulfilled some Microsoft capacity in Finland rather than in Vineland, New Jersey. And that could be a potential breach of contract that they had with Microsoft, as the contract apparently specified the capacity has to come from New Jersey. I've had long-standing concerns about the Data One CEO. On the date of some announcements regarding data centers, he posted he has a 100% Nebius stock portfolio and said he was up a lot of percentage points on it. Many people pointed out this is a clear violation of SEC or FINRA rules. This is because his company Data One is an important contractor for Nebius, and he's also promoting Nebius stock at the same time. Although it doesn't seem like any case is being made against him. When I looked more into the history of Data One, it's a French company that was created about 2 years ago, and this is their first US-based project. It seems like a ton of responsibility for them to be taking on their first project, which is technically overseas for them. Additionally, in New Jersey, there's been community protests. The site they picked is 200 feet from a sensitive wetlands area, and the facility doubles the power consumption of Vineland, New Jersey. There's a similar situation in the Alabama data center build-out where there's protests going on there, although Nebius did promise noise reduction technology to this community. Overall, my list of concerns with Nebius was growing during the month. That's in addition to a big rise in stock price, so I decided to allocate the funds elsewhere. Let's now take a look at some promising new ideas, and these first three are related to AI. The first is Analog Devices with symbol ADI. They make electrical products in AI, factory automation, energy, auto, and consumer. It's a very wide array of products that they sell. Upcoming revenue was guided for $3.5 billion, which would be up 35% year over year. And this most recent previous quarter was already pretty profitable. They had $1.54 billion of EBITDA and $831 million of net income. Currently, data center still makes up about only 10% of revenue, but automated test equipment also makes up 10%. The main reason I'm passing here is that the market cap of $195 billion has this business highly valued already, and it's well recognized by the market. Another company I looked at in the month is MaxLinear with symbol MXL. They make optical transceiver products, and they're beginning to compete with Credo. The stocks had an incredible run over the past month, being up nearly 300%, but it left me wondering if the price rise is justified. The current quarter was guided for 130 to 140 million of revenue, and they landed right in the guidance range with 137. Additionally, they had negative 45 million of net income. And it's hard for me to understand why this company is so unprofitable currently. The market really seemed to like their Q2 guidance of 160 to 170 million of revenue. I still have question marks on this business, why they are lagging on growth and profitability versus peers in the industry. The market cap for MaxLinear got up to $7 billion now, so it's not as cheap as it once used to be. Another AI-related company I looked at in the month is Bloom Energy with symbol BE. I mentioned this company last month as well, but there's been significant updates since then. They make fuel cells, which serve as an energy provider to data centers. This is a rapidly expanding business as Oracle signed another contract with Bloom. Bloom says they have the fastest time to market for energy now, and it's clean energy that's cost competitive versus gas turbines. The gas turbines also have long lead times for acquiring them. My initial take was the market may sell off this company for their Q1 seasonality, but it turns out I was completely wrong there. The market started to get some more appetite for growth names since that last comment, and Bloom Energy just produced a really strong report. Analysts were looking for $540 million of Q1 revenue, and it came in at $751 million. However, Bloom does seem fully valued to me, as the market cap got up to $82 billion recently. But this does sound like a really promising idea, and I keep going back and forth whether I should have a position or not. Let's now take a look at some promising ideas in the industrial space. The first company here is Forgent Power Solutions with symbol FPS. They are a recent IPO with electrical distribution equipment that is sold in data centers. In the latest quarter, they had revenue of $296 million, which was up 69% year over year. They also had EBITDA of $36.5 million, but net income was practically break even at $0.2 million. And this is with a gross margin of 34% and a market cap of $12 billion. Custom products grew to 79% of revenue, and the company is working on the most technically demanding aspects. Demand is running ahead of our expectations, the management said. Orders were up 268% year over year, and the company is hiring faster. One thing that was confusing to me was that the backlog is just $1.5 billion. I thought their backlog would be a lot bigger with the orders going up so much percentage-wise. The company did give a strong guide for the next 2 quarters, which averages out to $373 million per quarter. But I'm wondering here, how much faster can this company scale up before they hit some limits? Another company that I looked at recently is Ouster with symbol OUST. They make LiDAR and 3D vision hardware sensors that are used in vehicles, robotics, drones, and smart infrastructure. There's a physical AI platform along with AI perception software. But still 90% of the sales are hardware-based and 10% is software. It's worth knowing on the previous quarter that they posted, they had $21 million of one-time revenue, and the growth rate would have been 37% year over year without that. The guidance for the next quarter at the top end would be 45% growth year over year, but it includes 7 weeks of an acquisition in that number. The transcript for Ouster reads well with an expanding business, but I'd like to see the numbers proven out a bit more first. The next company I looked at is called Solve Energy, with symbol MWH. They're a recent IPO for a pure-play utility-scale renewable energy contractor. They're the #1 EPC for solar, or engineering and procurement, and they're #2 in battery energy storage systems. They build, operate, and maintain plants. Their Q4 had $794 million of revenue, which was up 80% year over year, and they had EBITDA of $70 million, along with net income of $36 million, but the gross margin is pretty low at 18%. The company has a backlog of greater than $8 billion, and they gave full year 2026 outlook guidance of 51% revenue growth year over year. With a market cap of $8 billion, this price seems pretty reasonable, but I'd like to see a few more public quarters posted first to see how this business progresses. Moving on to some more promising companies that I researched in the month. The first is SoFi with symbol SOFI. They are a financial company for consumers looking to become a one-stop shop. I checked out this company's previous Q4 report, which I was impressed with. I didn't realize the company was actually reporting their Q1 this week when I was recording the video. It seemed like the Q1 numbers landed pretty strong, but the company was unable to raise guidance. Both Q4 and Q1 saw 35% year-over-year member growth, with strong adoption of new products. Usually established financial companies for consumers are not growing their user base this much. The Q1 profitability headline stands out with 62% adjusted EBITDA growth. But the inability of the company to raise full-year guidance for 2026 after beating on Q1 numbers does limit my interest a bit. The next company I looked at is C Limited with symbol SE. They are an international e-commerce, digital financial services, and entertainment company. The full year numbers that the company posted are really impressive, especially on profitability metrics. Starting out with revenue, for the full year, the company got $23 billion, which was up 36% year over year. Net income was $1.6 billion, up an impressive 260% year over year. And adjusted EBITDA was $3.4 billion, up 75% year over year. The market cap for C Limited is $52 billion, and this makes the price to sales close to 2. It just seems like a stock that should be worth more. The company's Money product, where money is spelled MONEE, had $3.8 billion of revenue and grew 60% year over year. The Money product also had adjusted EBITDA of greater than $1 billion, which grew 43% year over year. And I'm wondering if Money can be enough of a catalyst for the market to regain interest in this name. The last company we researched in the month is called Calix, with symbol CALX. They make AI solutions for communication providers, and they have broadband networking equipment. There's also a cloud solution they call Cloud Calix. Revenue in the latest quarter was $272 million, which was up 32% year over year. And the next quarter's guidance is for growth of 28% year over year. The company is profitable with the EBITDA of $14 million, net income of $7 million, and a gross margin of 58%. Calix has a strong balance sheet of $388 million of cash with a $2.8 billion market cap. My take is this valuation seems very reasonable, or potentially the company is undervalued, so we might want to take a closer look here. Calix seems like a company which could get re-rated by the market, but I'm still not sure on this company's innovation level or competitive edge. Let's take a look at my final thoughts for the month. My confidence is back on track with wins in Ethos Technologies and Silicon Motion, and a lot of my other stocks had a nice recovery in share price as well. I'm now preparing for the earnings season with most of my companies reporting in May. The recent results of tech companies show the AI narrative is still on track, and I don't look to worry or overthink about when the train will stop. When a specific company underperforms, that is my sell signal. But I want to stay diversified with non-AI names as well. This concludes the video, and comments and feedback are always welcome here. As a reminder, this is not investment advice or recommendations to buy stocks. Thank you for taking the time to listen.